Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Today I want to go over some of the biggest mistakes that we saw in 2022 for new investors and how to avoid them going into 2023. Now, the reason we need to talk about these mistakes is because some of these can be repeated in 2023. For example, if you made a mistake around interest rates and invested in companies that are not built for that type of environment, well, we know interest rates are going to continue to go up in 2023. So how can we avoid these? What are some tools, tips, and tricks that you can use to become a better investor next year and for the next, let's call it 9 days or so before this year is over? So I've got, I think, 4 here, and we'll see how this shifts as we continue to go through. So the first one here is not paying attention to the balance sheet. So a balance sheet tells us how much a company has in assets, liabilities, and then what is left over is called shareholder equity. That's basically net worth, or what is the net worth of a company. So what are your assets? This includes cash, this includes property, real estate, inventory. Everything the company owns is on that side of the balance sheet, on its assets. Then you have its liabilities, which include any loans that the company has taken out, any things that they owe. They call this accounts payable. These are bills that say, look, I have to pay them. I haven't paid them yet, which means I owe them this money for whatever services that they had. And then you subtract those two things out, and that's going to leave you with shareholder equity. This is the money that belongs to us, the shareholders. Well, in 2022, we knew that interest rates were rising, and they did rise multiple times throughout the year. The Federal Reserve came out and said, hey, we're increasing interest rates by 75 basis points. That's 0.75%. And they did that a few times. And they rose the interest rates just last week by 0.5%. But in either case, they are still expected to continue to raise interest rates all through 2023. Now, we will see if they follow through with that. We'll see how intense those rate hikes are going to be. However, if you weren't paying attention to the balance sheet for some of the companies that you own, then you were hit pretty hard. I say this because we talked about Mullen Automotive the other day, and we saw, right, their most recent balance sheet, they had over $70 million in debt and only $17 million in assets. Well, if you are in a situation like that, whether you're an individual or a company, and you've got this much money, which is not a lot, so let's call it $17, right? You have $17 in cash and $74 million in debt, or $74 just to make these super even here, $17 in cash and $74 in debt, and you have to operate every single day. What are you going to have to do? You're going to have to take on more debt. If you have to take on more debt, you're paying it at a much higher cost, and that is something that's going to hurt the stock, and it's going to continue to hurt stocks. They're all in that category. This is one of the reasons why SoFi and many other relatively new tech companies that were borrowing heavily lost so much money this year. Carvana is another one. They took out a lot of loans and a lot of money to pay for their used car inventory at the peak of the market, and when things started becoming more expensive, or less expensive for cars, but also more expensive from a loan perspective, their stock tanked. That is one of the many reasons why Carvana is in the tank right now, including Mullen Automotives and several other companies. Any company right now, if you're not paying attention, that has way more debt than what they have in assets, those are the companies that tend to suffer the most so far in 2022. And I don't see that changing in 2023, because unless the situation changes, either they stop raising interest rates or they start to bring in more money, then that's going to be a situation that they're going to have to continue to deal with. So do always pay attention to the balance sheet. If you want a more detailed explainer of like what to pay attention to on a balance sheet and how you do all that, all you gotta do is let me know in the comments, and we can do a whole video on that, and probably do that in like 10 minutes or so. So if you need that, let me know. We can break all that stuff down. That's what I'm here for. All right, the next one here is not adjusting your portfolio. So every year, you're going to come into the new year with certain expectations and certain things that is supposed to happen, and you're always going to get a curveball, something you didn't expect was going to happen at all. One great example from this here channel, last year we knew that interest rates were going to go up. That is the one thing that we all knew was going to happen, and it did happen. However, in most cases, bank stocks tend to be the best place to go when interest rates go up. So, we were talking about bank stocks a whole lot last year. Then we hit January, then February, and March, and we realized that, hey, this bank stock thing is not working. Therefore, you need to go through and make an adjustment to your portfolio. There are some people that get married to the stocks that you have, and you just hope and believe and emoji your way to confidence that this stock is going to be what you think it should be. Don't do that. Don't do that at all. Now, I make my adjustments every 6 months. You can make your adjustments, I think, at most once per quarter. So that's 4 times a year at most. I like to do it half a year. I think it gives me enough time to find other options, but also not be someone who is making knee-jerk reactions every quarter. I think quarters are, while still doable, I think it's a little too reactionary, because what happened in Q1 and Q2 can be vastly different. So I like to use a whole half of a year, if that makes sense. I like to use 6 months at a time to reevaluate and see what I need to change. So for example, I would say by March or so, we said, look, let's move off the banks. Let's talk more about insurance. Let's talk more about healthcare companies, because those are the ones that are actually working. And that has worked for the rest of the year. And it may work in 2023. But what we didn't do is just hope and pray and continue to just hold on to bank stocks just because every other case in history that it worked. No, you do want to make small, slight adjustments to your portfolio. Just because you like it, just because you did your research and all that kind of stuff, doesn't mean it's going to be right. And it may not even be your fault, right? When we started to look into bank stocks and we looked at historical cases, every single time that interest rates went up, almost every time, banks went up, except in the cases where there was a threat of recession. And 2022, there was a big threat of recession. And technically, we're in a recession, at least for a little bit, even though it wasn't officially declared. So that wasn't something that was on my list. Didn't really expect that to happen. I even did a video about a tweet with Robert Kiyosaki where I didn't think we were going to be in a recession. And I was halfway wrong on that. So we'll see, right? But in either case, you got to build time in your schedule or in your practice, your process, your investing philosophy to make those quick adjustments or small adjustments on a periodic basis. Don't get married to something. Don't just, fall into the trap of, oh, well, somebody posted this and there's a bunch of moons and rocket ships next to it, so I have to hold on to it forever. You don't have to. If it's not working and you've had it for a while and the environment isn't great for it to continue working, then let it go and go find something else that's going to help you to become wealthier. That's the whole point of investing to begin with. All right. Next one is 2020 anchoring. When I say anchoring, I mean your basis for investing starts in 2020 and you think everything is relative to that. Now, I understand if you are new to your investing journey, you've only been investing for 2 or 3 years, it's hard not to think about that. To put this in a normal context or a context I think we can all relate to. So for example, I graduated in 2012 from college. So in my mind, the first place that I went to after college and my first job, I always kind of see myself there. So I went from Hampton University directly to Dallas. Like Dallas is, I grew up in Dallas, right? In terms of like as my adulthood after college. So I always think about like when people say, where are you from? Or what were things like after you graduated college? It's always the first place I go to because that was my anchor, right? 2012 was my anchor. When I figure out how old people are and they say, oh, I did this. And this year, I'm always thinking, okay, well, I graduated here. How many years away was it from that? What was the job that I had at that point in time? I'm always anchoring things back to that point in time. Some people anchor their investments in 2008. When we say that stock market is bad, everybody says, oh, well, it's the worst thing since 2008. People just anchored it to that specific point in time because it was the last time that the market was that bad. Others default all the way back to 1987. Others default going back to the dot-com bust in 2000s. Depends on how old you are. Depends on how long you've been investing. Well, if you've been investing and you just anchor yourself to 2020, that is very dangerous. And I say that because that was the strangest year on record where all types of stocks were up ridiculously high, for some for legitimate reasons, some for not so legitimate reasons. I think Tesla, if I remember correctly, I think Tesla was up like 438% or something crazy. Was Tesla really 400% better in 2020? No, that didn't make any sense. You had all types of random cryptocurrencies that were literally built off of memes and nothing else that were up 1,000%. Like, that was just such a crazy year. But if you anchor yourself in that, you may be led to believe that any stock, for any reason that is low quality, that doesn't really do anything, that could be a scam, is something that you should invest in, and that it's supposed to work that way over the long term. That is not the case. So you don't want to anchor yourself into 2020. The way to get around this is when you're looking at data, when you're looking at, let's say, a chart, don't just go back to 2020 and just look at that. What I like to do is say, look, let me look at the last 5 years. Let me look at the last 10 years. Let me look at just 2019 and then 21 and then 22 and just exclude 2020 altogether. Now, yes, 2020 is important, but think if you are looking at something like Zoom. Zoom was the best company you could have had in 2020 because it was a perfect storm. It was a virtual app. It was a virtual program where you could video conference and have meetings without being there face to face. You're in the middle of a pandemic. Nobody wanted to go outside. The perfect thing to have at that point in time. So the stock was up, I don't know, hundreds of percent. It took off, as it should have at that point in time. But is that a normal scenario? The answer is no. If I really want to know about Zoom, I would probably look at how it did in 2019, which is when it went public, and look at it in 21 and look at it in 22, and then let that drive my decision, as opposed to looking at the absolute best perfect case scenario, which honestly we would hope would never happen again, because nobody wants to go back to that point where the virus was at its peak and we had no levels of protection and didn't know what exactly this thing was. So always, get away from the best case scenario and just kind of give yourself a broader timeline to look at certain stocks and to give you a better indication of whether it makes sense or whether it does not. All right, the last one is crypto. Crypto was a mistake. I'm sorry. I'm not saying that the concept of crypto is a mistake, but we learned a lot about crypto and went none of it good in 2022. My learning here, the way to avoid this going into 2023, I'm going to tell you right now, I have no idea where Bitcoin is going to be. I have no idea where any cryptocurrency is going to be in 2023. I have zero predictions. I never really had any to begin with. But in either case, I honestly don't care. I'm still holding the crypto that I do have. However, the way to get around this is to still limit your overall holdings to 5%. So you got $100,000, $5,000 is the cap. And you just stop there because of all the stuff we've seen, from FTX to BlockFi to Celsius, all of this stuff. There's a lot going on and we don't really have all the information. We really don't. It has not been around on Earth long enough for people to study, for people to understand, for us to have a solid use case for what it is used for and how it reacts in certain markets. So what I would suggest is that you don't put so much of your money into it, because we all thought before 2022 that it was some sort of hedge against inflation. We've been saying that since 2020 or so, maybe even 2019 at the earliest. So finally we hit historic inflation. You would think that this was the time that they were supposed to be the strongest there ever been, and it was the worst ever because you had entire institutions absolutely fall apart in this type of market, which is not what was supposed to happen. So don't fall for that in 2023. I'm not saying you don't want to invest in crypto. You do what you want to do. But if you are, I would seriously limit it to a small portion of your portfolio so that if it ends up being more of the same, it's not going to crush your entire financial portfolio and your entire financial goals. I don't want that for you. I want, if it's not going to work, at least be contained, right? So, hey, it's a difference between, falling down one step and falling off a cliff. I would rather, if you got to fall, just fall one step, you be all right, dust yourself off. You fall off a cliff, you might not come back. So I don't want that for you. So those are the major mistakes that I saw in 2022 and how you can avoid them in 2023. If you want me to do more of a breakdown of a balance sheet and other financial statements, feel free to let me know. We do have some of these breakdowns already inside the members only. That link is right here. All right, that's it for me. Talk to you later. Bye.